Hello, my name is Jack Warner. Today I am starting lesson one of our step four, expanding savings and emergency fund. So one of the very first steps of winning with money is to build a savings in your emergency fund. And usually that starter emergency fund is pretty small. So step four, we're going to focus on how we expand that and get it to a more comfortable area that we can live on. And I'm also going to go over checking versus savings versus the money market, different types of bank accounts we can open and use for our emergency fund and the purposes behind them all. First of all, checking account. Most people have a checking account. It's like one of the first accounts they open up. And the importance, I'm showing people why opening a checking account is vital to their financial health is because it's protected when you put it into a bank. Some people don't trust banks, but the government is able to ensure that your money, your deposits are safe once they are deposited into a checking account. Much better protected than is if you leave it under your mattress or bury it in your backyard or put it in your underwear drawer. Checking accounts can also assist in many different areas of your financial health other than protection. You can set up auto bill pay. So with your checking account, whatever bills you're paying, whether it's a debt bill or a utility bill or some kind of other city bill or energy, whatever it might be, cell phone bill, you can set it automatically coming out of your checking account, and that is huge when it comes to paying off bills, paying off debt, and staying on budget. Convenience factor. So not just the setting up the automated systems makes it super convenient rather than you having to manually go and pay all these different carriers, these different debt owners that you have, or different bills that you have to carry. The convenience factor of not having to carry around cash or write a check, and you can use a debit card or online money transfer. You can use PayPal connected to this, Zelle, Venmo, Cash App, whatever you want to use. It's all connected to your checking account. Budgeting, of course. So I just mentioned that the auto bill pay and the convenience factor, but budgeting is a huge part of setting up the automated system with your checking account because it's super easy, super convenient, and all the transactions, if you're using some type of online budgeting tool, will automatically be updated when you're using your checking account. And so they go hand in hand. Savings account, a little bit different from a checking account. Checking accounts have an interest rate that you can earn, but it's virtually non-existent. You might as well just forget it's there. You're not really earning money with money in checking account. Used to be savings accounts were better. Today they are not so much in 2022, but I could see them in the future being a better area to invest, I guess, or to store some money. But they do earn interest rate, but not that much. It's not really worth anything either. The biggest things for savings account is they do keep ourselves disciplined because there's usually a limit on how much we can withdraw from the savings. So most savings, there's a withdrawal or maybe even a transfer limit. I also recommend that if you are budgeting and if you are trying to be financially fit, then setting up a direct deposit into your whatever income that you have, direct deposit into your savings account, and then transfer what you need to your checking. And this is according to your budget. So when you're setting up financial goals, you're setting up your budget, make sure to have your direct deposit from your job or from your business or whatever you make money from, put that into your savings first, and then transfer what you need to your checking. Create savings accounts that are in line with your goals. So set up financial goals. I'll show you later on, but you should have goals per savings account. So if you have 5 different goals that you're saving money for, create 5 different accounts. More on that later. And yes, there is some interest. I mentioned this earlier. There is slightly higher interest, but it's just not that much right now. So it's really nothing. And of course, this setting up savings accounts helps us develop healthy financial habits. CDs, certificate of deposits, they are considered savings, but they can be kind of a saving investment hybrid. They're more for long-term savings because the money that you put in a CD, it can earn more than a savings account. So they can have 2-3% interest, while savings right now are 1% interest, maybe or less. So CDs, they can earn more than a savings account, but your money is locked into that account for the term limit. So a certificate of deposit that you can get at a bank, they'll open up an account for you, and you are certifying that you're going to leave that deposit in there for a certain amount of time. So a year, 2 years, 3 years. You earn higher interest on it, but you cannot withdraw from there because, or you can withdraw, but only for a huge emergency, and you can get a withdrawal penalty. So you don't want to do that. So for example, here we have a $1,000 CD earning 3% interest rate for a term of 2 years. So if I knew I didn't need that money and I wanted to earn some interest, I could put it in for 2 years, lock it in for 2 years, earn that interest. But if I had needed to withdraw it, say a year from now, it would be a huge penalty. I'd be paying a couple $100, depending on the bank and the fines and fees associated with that account. So they are a viable option, but not that great. So CDs can be a great tool to build wealth. Just make sure it's not your emergency fund. So we are not going to put our emergency fund into here or even our savings. We're going to put in money that we are willing to give up for a while and money that we don't need immediately back until the term's done. Money market accounts are a little bit different. They can be a viable option to put your emergency fund, but we need to know the ins and outs of it. Savings accounts on steroids is kind of what I call MMAs, money market accounts, because you do get a higher interest rate, but it's not that much higher, especially now. On different economic times, different factors, that interest rate can increase dramatically. But as of right now, we're in the 1 to 2% rate right now. And sometimes MMAs might require a higher minimum balance just to keep it open. Where most savings, especially online bank accounts, you can open up with $0 or even $25. So what is a money market account? What it is it's like a large debt investment between banks. It involves money moving around overnight to different organizations, different banks, financial institutions. Basically, large funds are being transferred as loans overnight. Banks can make money off this, and so they're willing to give us regular customers a higher interest rate so that they can have that money to loan out to other businesses. So money being transferred as loans to banks, businesses, or the government uses it sometimes too. So they want to keep funding the money market accounts so they have money to give out in loans. That way they can charge other people a higher interest rate on those loans, and boom, that's how banks make money. They are a great place for emergency fund. Some offer little to no minimums. Some offer convenient withdrawal policies, easy access. Just make sure you read the fine print when you are deciding to park your money into an MMA, because they can, some of them might have stricter terms than others. So if you can find an MMA with great terms, it can be a solid place to put your emergency fund. MMA accounts, they are safe. They are FDIC insured, so you can't lose it all as long as it's under that $250,000 deposit limit, which that's a huge chunk of your emergency fund, I'm sure. No one needs one that big unless you're a business or something, and it's a great savings tool as well. So account purposes. You want to customize accounts to your needs and your financial goals. Account purposes, and I kind of suggest, these are all suggestions. I suggest linking all these to your budget plan, your program, your app, your software, whatever you're using. A checking account, you need to have one for normal expenses like groceries, gas, clothes, normal day-to-day supplies, etc. One checking account for big expenses, rent, house payment, utilities, debt obligations if you're paying off a car or a house or something. Those go in your checking account. Savings account and money market accounts, you need to have several for each. So if you have emergency fund, you need to you can label all these too on many accounts. Label a bank account your emergency fund and put that money in there, forget about it, that's just for emergencies. And then you can have multiple accounts for savings goals. So maybe you're saving up for a house, you're saving up for a car, you're saving up for your kids' college, you're saving for a cool trip you're going to take, whatever. Each one of those accounts need to be different. So you can have, in mine, I have two savings right now. I have just normal savings goal, and then I have emergency fund, and that's it. Now, if I decide I want to save up for other things, and I can change those whenever I need. CDs, long-term savings goals. So maybe you want to buy a house, years from now. You're not ready. You want to buy a house 5 years from now. You can put some money aside in a CD and reinvest it into the long-term savings goal. Say I want to buy a house 3 years from now, so I buy a 3-year CD, and I could earn a little bit more interest than any one of these can. Or if you just want to play around and have some small investment opportunities, there are some beefed up CDs, but usually you have to have a large minimum to get those kind of interest rates. So example template. This template is kind of how a very basic bank account should look. And if you have one bank account, it's a little bit easier, but that's okay if you have just a couple of bank accounts or only one bank and all these several accounts. This is kind of how you could set it up. So my normal expenses, this is meant for the short term. I have about $500 to $1,000 in it. Big expenses, also a checking account, usually going to be short term, so a month or less. I'm going to have about $1,000 to $3,000 in it because I'm going to be paying off my rent or my home note or insurance or whatever it might be. Emergency funds, you can put this in your savings or MMA. This is usually going to be short to mid-term, medium term, and I want to eventually get, and I'm going to talk about this in a later video, 3 to 6 months of expenses. And then we have our different savings goals. So savings goal 1, savings goal 2, I have a savings account or a money market account. And these can be short to medium term, money for a car, tools, other essentials. So this can be somewhere between 1 year to 3 years. Money market account, money for a down payment on a house. So this could be a short to medium term, so maybe 3 years. The savings goal 1, likely no more than $10,000 in this one. Savings goal 2, depending on where you live and how much house you want, probably somewhere between $10,000 to $30,000. And then your CD, your certificate of deposit, extra savings boost for future goals. So if you know something like I want to start a business 5 years from now and I don't need this $5,000 that I have left over surplus, then I'm going to put it into a CD and help build wealth. And then eventually an investment account, which we're going to talk about in the next video series and the next step. But the investment account is going to be more long-term, more about building wealth. So next few lessons, we are going to break down how to build that emergency fund, how to start generating more savings goals, and what we can do to help make more sound financial habits when we are picking different bank accounts and starting different savings accounts.